Okay, here we are with chapter 12. We're going to practice three different types of bonds. We're going to practice if a bond was issued at face value, at discount, and then at premium. So in this first video, we'll just practice if it's issued at face value. So here we have Archer Spice Supplies. They issued 70,000 of a 10-year, 9% bond payable on January 1st. They pay interest each January 1st and July 1st. And if it was a discount or premium, they would amortize it using the straight line method. They can issue the bonds payable under various conditions. And the first condition we're going to do is face value. So that's the easiest one. That is just at the issued price of 70,000. So that will be how much cash Archer Spice Supply is getting. And so let's go ahead and do our first journal entry. So we have January 1st, and I just said at face value, it's just the amount that was listed at the issued price. So that is 70,000. So let's go ahead and just record a debit for 70,000. And then what do we have due? You have a bonds payable due. So we have a credit. Nice and easy there. Perfect. And then now we're going to go ahead and record the semi-annual interest on the bonds that were issued at face value. So not too bad. We have, as a reminder, to calculate interest, we would do our principal times rate times time. And I always shorten it to just being P times. All right. And then so we have here the principal is the face value, and then times the rate times time. So that would be 70,000 times 0.09. Let's make sure that was the rate. Yep, 0.09. That was that 9%. And since it's semi-annual, that would be 6 months out of 12, right? A half. All right, so there'd be 2 payments within that year. And so we'll do a little bit of math to get that. So we know, let's go ahead and clear that out. All right, so that calculator's fixed now. All right, so let's go ahead and go 70,000 times our 0.09 rate times 1/2, right? Or divided by 2, whichever way you want it. But it's twice a year, and so that was 3,150. All right. So that is our interest that's going to be paid out in cash as well. So that's our interest expense and our cash that's being paid out. Let's go ahead and do July 1st, our first interest payment. And we are all done with face value. That's not too bad. So in the next video, we'll do one at a discount.